Crypto didn't explode overnight. It crept in, quietly, steadily. And in 2025, it's no longer a fringe experiment, it's becoming the core of how money moves. It began with a Senate vote most people didn't even hear about, a bill called the Genius Act passed with bipartisan support, 68 yeas to 30 nays. It legalized and regulated stablecoins. Not NFTs, not Bitcoin, not meme coins, stablecoins. The boring kind of crypto that doesn't go up or down, that just works. And that's the secret. It's boring, it's stable, it's useful. And now, big money is finally paying attention. Just weeks after the Genius Act passed, Circle, the company behind the dollar-backed USDC stablecoin, went public. The IPO raised $1.1 billion 0 cents, and within days the stock soared 700%. Wall Street wasn't just buying shares, they were buying into a new financial system. And then everything exploded. Coinbase, the US-based crypto exchange that earns nearly half its revenue from USDC, announced partnerships with Shopify and Stripe to let millions of businesses around the world accept stablecoin payments. Not in theory, in practice. Right now, Fiserv, the giant behind 90 billion annual card transactions, launched its own stablecoin to power instant, borderless payments. JP Morgan rolled out JPMD, a commercial deposit token functioning like a stablecoin, available 24/7, bypassing overnight fees from the Fed. And then came the corporate stampede. Amazon and Walmart, yes, the two biggest names in American commerce, started quietly experimenting with their own tokens, not because they love crypto, but because they hate paying $187 billion 0 cents in card processing fees every year to Visa, MasterCard, and Amex. The very next day, Visa and MasterCard stocks slid. The market saw the writing on the wall, a world where stablecoins replace the plastic in your wallet, and those very card giants, they're not resisting, they're adapting. Visa now lets companies issue Visa credentials on top of stablecoins. MasterCard is integrating with Paxos to settle payments using dollar-backed tokens. The goal? Real-time payments, globally, with a fraction of the fees. Treasury Secretary Scott Bessent said it clearly in March 2025. Stablecoins can unlock a $2 trillion 0 cents market and potentially help stabilize the U.S. deficit by becoming one of the largest buyers of U.S. treasuries. And he wasn't exaggerating. In 2025, Circle and Tether, the two biggest stablecoin issuers, became top 10 purchasers of U.S. debt. As China and Japan pulled back, stablecoin demand surged, filling that gap. Crypto now props up America's debt, but not everyone's cheering. Under the Genius Act, stablecoin issuers aren't allowed to pay interests, at least not directly. So while they park billions in U.S. treasuries, earning 4-5% yields, you get nothing for holding their tokens. That yield? It goes to them. And when stablecoins become your default payment method, it's like putting your money in a checking account with 0 returns. Lawmakers say this needs to change. But the industry is already sidestepping the rules, calling it rewards, cashbacks, token benefits, anything but interest. And then there's the risk. Crypto still carries scars from the 2023 USDC depeg, triggered by the Silicon Valley Bank collapse. For 48 hours, a supposedly stable dollar dropped below 90 cents. Billions evaporated in minutes, trust was shaken, and yet here we are, 2025, and the adoption is faster than anyone expected. In Argentina, Venezuela, and Nigeria, stablecoins are now the default currency for e-commerce, savings, and even payroll. They're more trusted than local banks, because they don't crash, they don't hyperinflate, and they move instantly. Even here in the US, millions of users don't know they're using stablecoins. But behind the scenes, apps like PayPal, Cash App, and Venmo are quietly testing stablecoin infrastructure to reduce costs and speed up transfers. And now, the Genius Act gives them legal cover to go even bigger. First, there's political controversy. The launch of $1 0 cents, a stablecoin linked to a DeFi project reportedly backed by Trump-affiliated interests, raised serious eyebrows. Senator Warren warned of conflicts of interest, especially after a $400 million 0 cents investment from a UAE firm was linked to the token's development. The White House insists there's no conflict. Trump's assets, they say, are managed in a blind trust, but the scrutiny isn't going away. What's clear is this: stablecoins are no longer about crypto. They're about control over payments, over regulation, over monetary flow. It's not about hype anymore. It's about infrastructure. We've seen this before. The credit card was once a strange, untrusted piece of plastic. The internet, a toy for nerds. Now, both are lifelines. Stablecoins are next, and the race is on, not just to build them, but to own them. Because whoever controls the rails controls the economy. If you thought crypto was just hype, think again. The real revolution isn't happening on trading apps. It's happening under your nose, in your banks, in your grocery stores, and in your paycheck. Hit that subscribe button for more stories that break the surface and show you the future of money. Because while everyone's watching Bitcoin, the real power shift is already happening, and it's stable.